tumultuous 2 years, City Union Bank is on the path to recovery, which can also be seen in the bank's FY22 performance. Advances growth improved, which along with the credit costs drove an earnings growth of 28% in FY22. The pandemic-induced economic crisis pushed CUB to shift focus away from business growth to preserve capital, manage portfolio stress, reduce costs and maintain adequate liquidity. Hence, its loan growth slowed down to 5% in FY20 and 7% in FY21. The bank focused only on gold loans and ECLGS in the past couple of years due to low risk weight on these loans, and that helped the bank improve its capital adequacy ratio. Not only did the credit growth nosedive, but stressed assets also soared in the past 2 fiscals as CUB's borrower segment was highly vulnerable to the economic downslide. Remember, CUB predominantly lends to self-employed segment, small businesses and MSMEs, all of which were severely impacted by the pandemic. GNPAs increased to 4.7% at the end of March 22 compared to 2.9% in March 2019. The bank's restructured loans amounted to 2,184 crores. The good news is that it has seen a good progress in Q4 FY22 and the outlook for FY23 looks quite promising. Let's take a look at the key drivers of future growth. First up, accelerated loan growth. While loan growth improved to 11% in FY22, around 60% was contributed by gold loans. Consequently, the share of gold loans rose to 22% in March 22 from 18% in March 21. However, gold loans contributed only 30% of loan growth in Q4 FY22, and this momentum of non-gold loan growth is likely to continue in FY23 as well. Going forward, CUB is targeting a low to mid-teens loan growth in FY23. Now, CUB's funding profile is modest as the share of low-cost CASA deposits is just 33% of total deposits, which is much lower than the industry average. However, it enjoys high yields on advances, mainly driven by small-ticket loans to MSMEs and trading, which constituted 51% of CUB's loan book as of March end, and product mix tilted towards working capital facilities. Management is confident of maintaining NIMs at around 4%, and the impact of rising rates could be maximum 10 to 20 basis points. Number 2, improving asset quality. Q4 FY22 was a good quarter for the bank as recovery surpassed slippages, leading to a reduction in GNPA. The recovery in Q4 FY22 was the highest in the bank's history, and the management expects it to further improve in FY23. Slippages also declined in Q4 compared to previous quarters, and the trend is likely to continue. Management has guided gross slippages ratio to decline to 2 to 2.5% in FY23 from around 3% in FY22. Higher recoveries and reduced slippages will bring down bank's GNPA in FY23 and drive improvement in return ratios. Since management is expecting higher recoveries over the next few months, the bank is adequately covered to absorb losses. The most encouraging bit is that the SMA2 assets, which used to be in the range of 5 to 7% of loan book in pre-COVID days, has reduced to less than 1.5% of the loan book as of March end, suggesting significant improvement in asset quality. Operating costs are likely to remain elevated in FY23 as the bank pursues growth. At the same time, non-interest income will be muted. CUB's customer profile limits its ability to cross-sell products, resulting in lower core fee income compared to larger private banks. Moreover, the bank does not see significant contribution from treasury profit front due to unfavorable yield movements in FY23. Consequently, cost-to-income ratio could inch up to 42 to 45%. The most heartening thing about CUB is that the management has delivered on all financial parameters as per the guidance. They had guided to improve return on assets to 1.5% by FY23 and has already delivered 1.4% in FY22. CUB's stock, if we look at it, it has corrected 28% from the peak. Valuation has moderated to 1.2 times book value estimated for FY24, way lower than its 3-year historical average of 2.6 times and peak valuation of 3.8 times book value. In the medium to long term, investors can expect valuation re-rating with improvement in return ratios as guided by the bank. Investors therefore should buy the stock as it offers attractive risk reward after the recent correction.